Hello, Profit Hackers. I'm Jeremy Lott, the Chief Visionary for Foundation Accounting and Consulting. I owned a construction company for about 15 years before making a change to accounting because my accountants sucked. My goals are to simplify accounting for construction company owners, fuel your profits, level up your cash flow, and help you grow in a financially responsible way. So let's go. Hello, Profit Hackers, and welcome back to the Contractors Profit Hack Show. This is Jeremy Lott, and we are still talking about budget. We've got this episode and the next episode to kind of wrap all of that up. But with the budget, we've already talked about what to focus on and coming up with your strong why, and then putting a value to that and figuring out based on the amount of money that we need to make to reach our goal, our why. We've figured out what our break even needs to be, how much money we need to be bringing in each month in order to reach our why, in order to reach our goal, right? So today we're going to talk a little bit more about how to get to that final number. I want to talk today a little bit about a prank war that my daughter got into. When she was younger, and we had some young women's activities for church, and one of the leaders was one of the young men's leaders, and his name was Mike Madsen. And Mike was a good friend of the family, and he was a lot of fun. We had a lot of fun times with Mike in the young men's and young women's organizations of our church. And one particular time, my daughter got a bunch of ducks, and they snuck over to Mike's house and put a whole bunch of ducks in his truck. And so, of course, Mike came out, found all the ducks. He was really good about it, laughed, and then decided that he was going to get back at my daughter. And so this continued for a while, and my daughter ended up getting ahead with a prank where she made an elf on the shelf thing, stuffed animal for Mike's younger daughter, and committed Mike to having to move that around all Christmas. And so they decided to get back at her, and they ended up coming over one day when she was gone and putting glitter all over my daughter's room. Well, it was large glitter. It was probably more like confetti, but it was also, some of it was like metallic. So if you stepped on it, it would really hurt because it'd dig into your feet and stuff. Well, my daughter got home and saw all of that and was pretty mad and wanted to go do something big to get back at them. Well, my wife and I were tired of the prank war and tired of cleaning up after it. So we forbade her from reciprocating because we knew there would be a retaliation if she did something back to Mike. And so we kind of ended right there. But this whole thing reminds me a little bit of the Stephen Covey book, 7 Habits of Highly Effective People. And there's one part in there where he talks about picking up a stick. And he says that you can't pick up one end of the stick without picking up the other end as well, right? Meaning that every action that we take, there is an associated consequence. Now, sometimes those consequences are positive, but other times it's going to result in somebody pranking you back and causing even more damage than what you did. So we had to put a kibosh on that, much to my daughter's chagrin. But that was a valuable lesson there that Covey is right. When you pick up one end of the stick, you definitely pick up the other end of the stick. So in our businesses, when we pick up revenue, the other end of the stick that we're always going to pick up are the costs associated with that revenue, the costs required to produce those products or services so that we can then do the work that we've agreed to do, right? So there are costs of goods sold. Within that cost of goods sold, the things that go on the truck to the job site, we have 2 different categories. The first category is the direct costs. And with the direct costs, we have all the items where one receipt goes to one particular customer. So I go out and I buy some materials to put into a job. Those materials are for that job. I get one receipt. That one receipt can be credited towards that one customer, right? And there are a lot of different materials that we as contractors use to go into our jobs. Some of the other things that we would consider direct costs are labor. As we have our people out working, they're working a certain number of hours on a specific job. And while they do that, we can track that, and then we can credit that pay towards that one specific job, right? Those hours they work on that job go to that job. And so that's a second type of direct cost. A third really common one is subcontractors. When we hire a subcontractor to come do something for us on the job, then we end up getting one receipt from that subcontractor, and that one receipt goes to that one job that they worked on, right? The last couple of categories are the same type of concept, but we have things like dump fees, like permits, those type of things, right? When we have dump fees, it's for a specific job. Or when we go pull a permit and have to pay for a permit, it's for a specific job, right? So those are other direct costs. We get one receipt, it goes to one customer, okay? Then we have all the other things that go on the truck to the job site. We call these indirect costs or overhead costs. This is because when we go fill our truck up at the gas station, we get a receipt, but that one receipt needs to be thrown in a bucket and spread out over all the jobs, right? We're not going to just take one receipt and put it toward one job. We're going to throw it in a bucket. We're going to dump it out on all of our jobs. And so those overhead costs are things that we need to track as well. Well, the reason that I'm talking today about those 2 different types of on the truck costs is because it matters a lot when we're coming up with a budget. Some of those specific items we can consider a percentage of revenue. Now, on the truck expenses as a whole are a percentage of revenue. And in the last episode, we talked a little bit about 70% cost, which means that 70 cents of every dollar goes toward that job, right? That includes the amounts that we pour out onto each job from those overhead buckets. As we look through our costs for the previous year, we can start to narrow down how to attribute those to specific jobs and how to figure out how much we need in costs, how much we need to include on the budget, right? So 70% was the total, but of that, let's say that 30% of that is for our materials. We'll also say 30% of that is for our labor. And then that leaves 10% for our overhead, right? So we can now go in and we can take that revenue that we have to make each month and we can multiply it by 30%, and that tells us how much labor we need. We can multiply it by the 30%, and that tells us how much we need to count for in materials for those costs. That leaves 10%. The overhead category can be a little bit tricky because we do have some recurring costs that show up in the overhead costs. A good example is insurance. You're going to pay the same amount in insurance every month, right? So rather than putting 10% down for overhead, we want to list any specific recurring costs that we have that are overhead. So we'd list our insurance, and when it comes out, we would list our other items like that and when they come out. For instance, the registration and licensing of vehicles. You know what months that's going to happen. You know how much that's going to be. So we can put that amount in that month for creating our budget, right? And so what we need to do is we need to figure out what 10% is, 10% of our revenue. And then for those fixed costs, we can subtract those each month from that overall 10% amount, right? And then the remainder will just be a plug that helps us be able to get to 10%. So again, if we're at 1.5 million and 10% overhead, that leaves us with 150,000. So of that 150,000, we have 50,000 going toward insurance, and we're going to put that into each month. Well, that leaves 100,000. So we have to include that 100,000 in each month as overhead costs, non-specific overhead costs, right? That helps us to be able then to figure out what specifically we're paying for throughout the year and what categories they go in. Just another quick note, as we are working on putting our budget together, we're going to have all these different categories that we're spending on going down the left side in the columns, and then going along the top in the row, what we're going to have is the month, January through December for that year, right? And so we're going to fit those costs into the correct months based on the revenue and based on the non-specific recurring costs and the specific recurring costs, right? So I know I've said a lot of confusing stuff there. I want to back up again for just a minute. Every time we pick up $1 of revenue, that stick, if you will, we're also picking up 70 cents of costs. That's our total costs. Well, as we inspect that total cost of 70 cents, we determined that 30 cents of that 70 is going to labor, 30 cents is going to materials, and 10% is going to our overhead or our non-specific and specific recurring costs, right? So the 10% is that $150,000 that we talked about. And we're going to first subtract all of our specific costs, which is the $50,000, so that leaves $100,000. And then we're going to have our plug that will get us up to that full 10%. So let me put this into specific numbers, okay? We'll say that $10 is the revenue that we need for the month. $3 we need to budget that month for our labor. We need to budget $3 for our materials. That gives us $6 full dollars, right? Well, then our overhead is 10%. So we've got one more dollar on top of that, and that gives us our $7 total dollars, right? But we can go back to that $1 and we can break it up into any specific recurring costs that we have. So from that $1, we can subtract our insurance for that month. And we'll say the insurance is 30 cents. So we now have, well, just to make it not confusing, we'll say it's 40 cents. So we can subtract that 40 cents from the dollar, and that leaves us instead with 40 cents and 60 cents. 40 cents is the specific item that's coming out each month. 60 cents are the other items that are not recurring costs, things like fuel and our workers' comp and those kind of things that go up and down based on the direct costs, okay? So this is Jeremy with Foundation Accounting and Consulting. If you need any help at all trying to figure these things out, give me a call. Reach out to me, and we can set up a free time to chat and help you be able to put together this budget so that you can reach your goals. So this is Jeremy, and I will talk to you next time. Thanks for listening. If you found this episode helpful, please like and subscribe for weekly episodes to help you fuel your profit, level up your cash flow, and finance your growth. Until next time, go enjoy some green M&Ms and protect that cash.